Hi, everyone. Welcome to the TimingResearch.com Crowd Forecast News, episode number 267 for June 15th, 2020. We are recording this at 1 p.m. Eastern Time. My name is David Cosmeter. I'm the creator of TimingResearch.com, and today we are going to be talking about the S&P 500 and what we think is going to happen in the markets this week. So today I have arranged for Marina Villatoro, Gary Dean, David Keller, and Jim, the option professor, to be here. And Jim will be moderating, so I'm going to go ahead and turn it over to you.
Great. And good to be with you, everybody. This is going to be an exciting show because there are a lot of things going on in the market. Last week, we got a big sell-off on Thursday. Today, we took out the low from Thursday by about 10 points or so, and we've come about 75 points off the bottom. So a little bit of a reversal look. So it'll be interesting to see what the guests here think of the action, not only today, but what they're looking forward to. Got a great panel. Marina Villatoro of thetraderchick.com. Gary Dean of sentimenttiming.com, and David Keller of stockcharts.com. Some of you guys are new to the broadcast, are not familiar with these guys, so we're going to quickly go through an introduction and what's going on at your company. We'll start with Marina and thetraderchick.com.
Hi, everybody. Thank you so much for having me, David and Gary, for moderating. So I am a scalper. That's my nature. So I will be talking more about like the very, very small look, I guess, a forecast for the market. I don't really pay attention to the whole one unless it's for my investments. And I mainly trade the ES Mini.
Okay. And at the end of the broadcast, of course, you'll let everybody know how to get a hold of you and things that you could provide. Right now, Gary Dean, sentimenttiming.com. A little background, Gary, and what's happening at Sentiment Timing.
Alrighty. So I've been in the market since 1995, and Sentiment Timing, I run it with Woody Dorsey. He's one of the only people that I know of that actually tracks sentiment, investor sentiment. And our newsletter, basically, we go off of how you really track how investors are feeling about the market. And then from there, he has specific turn dates for tops and lows. And we're really on it. Our time periods run anywhere from 3 to 6 weeks, and we really just concentrate on the S&P 500. So it's more of a market timing newsletter that we produce, and that's really about everything. And I do more of the technical analysis part of it. So Woody does the investor sentiment, the turn dates, and then from there, what I do is the support resistance, wave structures, and stuff like that to kind of predict when it's going to when the S&P is going to reverse, and then from there we start looking at where it's going to reverse with both aspects of that for our newsletter.
So you first look at the timing, and then you look at the positioning on the charts and come up with the turning points.
Yep. So
Okay.
so Woody he produces the turn dates. Actually, believe it or not, the top date that was predicted on May 4th was June 8th. So it was the exact date on it.
Mm-hmm.
And we had a series of extreme bullish sentiment readings, and that
Right.
typically happens at the tops, and the wave structure all fit. So that was we kind of went short on
Well, that was good.
day.
That was a great,
Yeah,
great
worked
deal,
out
yeah.
great.
Yeah.
Yeah.
And like I say, the indicators were there because it definitely, when you hear Hertz goes up 10 times in value and they're bankrupt, that's not a good sign for, froth, right?
Yeah, there's definitely your retail spec traders have taken over the market back then. I think they definitely needed a little kind of a reality check, I think is
Sure.
the best way to put it.
Sure. Well, David Keller, stockcharts.com, little background on yourself and what's happening at Stock Charts.
Hey, good afternoon, everyone. Happy to join the show for the first time. I'm joining you from Redmond, Washington, outside of Seattle. So it's raining today, which is a nice change of pace for us here. I've been at stockcharts.com for about just over 10 months now as chief market strategist. And our goal is basically to provide tools, commentary, education to empower individual investors and financial advisors to make better decisions using technical analysis, using the power of charts. And I also run my own firm called Sierra Alpha Research, which is a research and coaching firm for financial advisors primarily to help them improve their decision-making using technical and behavioral investing techniques. And before that, I was at Fidelity Investments in Boston. I was a director of research there. I ran the technical research team for about 8 or 9 years there. And yeah, so with stockcharts.com, it's a very technically oriented approach that we talk about, and have a lot of commentators sharing different perspectives based on the trends, based on the momentum. So I'm probably a little more of a longer term investor than others on the conversation, but always pay attention to the tactical read, the short term, because that's how you operate your long term strategy. You have to play in the short term, and so that's why I pay attention there as well.
Okay, and great to have you here, David. The first question we generally ask each week is, what do you guys think the market on the S&P will do between now and Friday? Maybe not be appropriate for everybody, but we know Marina, of course, that could be long-term for Marina, but it's definitely a little shorter term than the rest. But SPX opened up at around 29.93, looks like. And Marina, what's your feeling between now and Friday?
So yeah, for me, an hour is long term.
That's right. I know that. I know
go
that.
for the one. Yeah. So honestly, following the market lately, it's been so crazy. I honestly don't even really understand why it's just flying more than it was before it crashed, because we're still in like a massive uncertainty zone. And I feel like I get the retailers. I totally get a lot of the retailing situation that's going on in online businesses. I do things differently. It's more of what makes sense to me. Like Amazon is booming, Facebook is booming. Like I'm just giving like very general examples in those categories. But that makes sense. We're online, we are getting stuff delivered. But then there's all these other businesses that are doing well, and there's really no explanation behind it. And I think that was the reason why it crashed last week, because people are starting to kind of wake up. The unemployment it's just growing, right? So I believe that this week, maybe even for the next couple of weeks, it will be bouncing back and forth in a very large indecision zone.
Yeah.
Because we're still kind of hanging out. I mean, everything crashed right after FOMC on Wednesday night, right? So I believe that it's going to be that indecision zone. People are just kind of waiting to see what's happening, right? Especially with the whole outbreak re-happening in Beijing, which I think a lot of us have been kind of looking to see it's China as like the goalpost, and all of a sudden they're going through another outbreak. So that all affects everything, right?
Yeah, between now and Friday, you're looking for it to be choppy, but would you say it
Yes.
might be higher than 29.93 by the end of the week, or it's hard
I
to,
think
you're
it'll
saying
be probably between 3,100 and 2,900. I think it's just going to be bouncing back and forth. It's going to get narrower.
All right.
Yeah, for
Okay.
sure.
And Gary, 29.93 between now and Friday, best guess?
I would be looking lower on this, but it's kind of tricky because what Marina was just saying is pretty much it. I'm expecting choppy waters, but the bias will be to the downside. The only reason why I'm saying it's a little hard to answer is we had a couple extreme sentiment readings from last week, and
Right.
as far as the wave structure and stuff, it's actually looking for a bounce. So
Right.
we could it very well we could bounce into Wednesday and
Right.
possibly even to that 3,100. But my thought process is just use any bounce that you can to build short positions, because I don't believe that we've come we most likely we're going to be looking to test the lows that we made in March at some point. But for this week, can I go with neutral? Because
Yeah.
we really honestly, like if
Yeah.
we closed at 3,100, it would fit a profile.
Right.
If we closed down at 2,900 or 2,800, it would fit. So
Right.
it's a tough one. I'm neutral on it just because of the wave structure
Right.
is looking for a bounce. So it's just a matter of how long it bounces for before they pull the rug out and we start heading back down again.
Yeah, I think the negative readings you got from last Thursday, plus that 29.75 former high points, makes it a little uncomfortable to get real negative right down here.
Right, right. That's actually one of our in our morning notes. I told people, I said, if you get down near the 2960,
Mm-hmm.
it not a bad idea to slim some of your shorts down and just look
Right.
to reshort it.
Right.
And they've been following the wave structures pretty good. That's for sure. But I as far as for this week, it's a I could see us finishing right where we opened actually, like
Right.
in going
Right.
up at making 150 200 points up and down before we get there.
Right. David, when I hear stock charts and I hear your background, with Fidelity and stuff, are you more of a intermediate, longer term guy, or do you also do the short term trading as well?
So certainly, I mean, my investment horizon is certainly more longer term. So for
Right.
me, I'm probably the opposite of Marina, right? So long term
Right.
for me is a couple years, and
Right.
short term is a couple days to a couple weeks.
Okay.
But having said that, that short term tactical read for me is very important, and I think we found that at Fidelity. If you're trying to accumulate a position over a 3-week period, it's all about your picking your battles during that time and identifying pockets of short-term weakness and strength. So I think that the tactical read is certainly important. If you're a long-term investor, I think you gain a lot of a potential return by paying attention to the short term as well.
Because you're looking at things on all different lenses, I was wondering, do you follow other indexes like the transportation and the Russell? Because one thing that I found disconcerting is that they have not gotten above their 1, 2, and 3-year moving averages. They tried last week and then they failed miserably. And then they never made a new high from 2018 during the rally of 2020. They kind of told me that the rally wasn't going to last. So without the transports and the Russell getting back on the horse, do you think that the stock market may have trouble getting back on the horse for sustained level?
So I think you've hit on a couple divergences, and I think they're playing more too, right? If you zoom out far enough and look at the S&P 500 and the Nasdaq 100, if you're thinking of the market as the Nasdaq 100 and thinking of the leadership in technology, you probably feel pretty good because we've gone to new highs. The Nasdaq 100 broke 10,000, which is pretty significant. And now it's pulled back a bit, but during that same period, all those other things that you mentioned, transports, the Russell 2000, the S&P, all have now made lower highs, from February to where we're at now.
Mm-hmm.
And I think, it felt like we were potentially leading to another double top, sort of like Microsoft sort of getting up to that resistance level. But I think Thursday and Friday of last week solidified the fact that we're at the very least at a short-term top here, which I think makes all those divergences that you just suggested. I think it makes them more and more meaningful. And to me, I think Gary's point was fair. I think the weight of the evidence is more negative than positive over the next couple of weeks, next couple of months because of that weight. I think that there's limited potential upside. The idea that the S&P could dramatically break above its February highs, I think, is minimal. The potential that we would have to back and fill lower from where we're at, I think, makes a ton of sense. And so I think you're right. I think those divergences are key. For me, I look a lot at individual stocks as well, and I would say if you look at individual names, there are plenty that are right at really key support levels. Something like Twitter's pulled back to its 200-day moving average, and there are a lot of stocks kind of like that are right at key support levels, which for me, I'm always trying to get inside the head of other long-term investors. And I would say if stocks like Twitter break below a key support level, that's when they will capitulate and start to take profits, start to sell. And that's what will move a chart of the S&P down a little bit.
I got you. Hey, Marina, we normally go over confidence levels, how confident you are. I think you're pretty confident that we're going to be in a trading range. But turning the table a little bit, on your shorter term trading, do you only use the indexes or are you using individual stocks? And if you're using individual stock, well, what indexes and what individual stocks are you using to do this short-term trading?
Oh, so no, I'm 100% intraday, and I only do the E-minis, which is the S&P 500.
Sure.
And usually my trading is usually 1 to 3 minutes. I'm very tiny, so I don't even really look at the overall picture. Sometimes I don't even look at the price action. I just literally just focus on the charts and the patterns and the technical analysis. So yeah, just the ES.
Okay. And you use a 15-minute chart or a 5-minute chart or what?
Oh, right. So I do 610 tick charts, which is, if nobody understands what tick charts are, I'll just tell you really quickly. For instance, if you're looking at any one of these candlesticks, or any bar, whichever you decide to use, it's about 610 transactions per candlestick, per bar. So it's not a time frame, it's literally watching the market in real time, what's going on. Because if you're doing intraday trading and you want a volatility, volumes could be really the volume indicator I find to be lagging. So when you're seeing what's happening in real time on each bar, which is the 610 transactions, to me that's the most movement, right? Like if it's boring, if there's nobody there, you don't want to really be trading. So I don't use a time frame. I use the 610 tick chart.
I got you. And is that available to anybody? Because I know when I
Oh
look
yeah.
at charts, it's just 5 minute, two,
No, absolutely. Everywhere. So you are just on a regular Yahoo Finance. No, you need to be on a
Yeah,
platform like
I got you.
Thinkorswim,
I
uh,
got you.
Ninja Trader.
Yeah, we're
Yeah,
gonna
some
get
of
into
them actually do.
yeah,
You know
we're gonna
what?
get into that later. Yeah.
No, you could go on interval one day and you should see ticks. Ticks is a very universal. Yeah,
Good.
just go into interval. No,
Oh,
where it
I
says
see.
interval.
Yep.
Yeah, go there.
Yeah.
So, okay, it's really limited here, but yeah, absolutely. Tick charts are they're pretty standard,
Yeah.
actually. But a lot of people use them.
Yeah,
Yeah,
I'm not that familiar with it, and many of the listeners might not be. So at the end of the broadcast, they could get a hold of you, and you can explain that among other things. You know.
sure.
Yeah.
What happened?
Uh, Gary, with regard to your confidence level on the market being a little bit choppy, maybe a little bit of a rally, you feel pretty good about that? And what's some of your reasonings right now on what's going on?
Well, right now, confident, like if we're going off of where the market opened today at the, say that the 2990, from there, that's where it gets a little bit of, it's tough to call whether we'll be below or above it. But from Friday's close, let's say the S&P is up 6 points or whatever from here. From that, I really could see us, my confidence level on this being very, very choppy and us ending in the same spot, if not a little bit lower. I'm going as high as 85% on this, and really the main reason I think even if they start heading back up, I think the damage that was done psychologically on Thursday from a lot of let's what I'm calling the retail spec traders, they bruised them a lot. So anybody that got trapped in that big trade, any kind of bounce that we have anywhere near the 3100, I think you're just going to find a lot of people just really saying, okay, I'm getting out of my positions here, and I'm going to take a less of a loss than what I just saw on Thursday. So I think anybody that any bounces that we get, you're just going to find natural sellers that are people that got walloped, listening to your financial media kind of saying that we have a V-shaped recovery and we're heading to new highs, and everybody was just diving in. So I think that any bounces will be sold off on that. And plus I think that it activated a lot of bears as well that missed say the big move that we saw from February into March. So they know it's back again. So I think that just natural resistance and natural sellers anywhere near that 3100 level is going to be pretty fierce. And from there, I just think the gaps that are underneath this market, there's something like 23 of them from the March lows. It's a foundation that's built on toothpicks, is what I call it, because once you start breaking any support, those gaps just collapse. And I could really see us testing the 2720 level, maybe even by week's end. That would not surprise me at all, where we see something like that. But that's a little bit too early of a time period. I think, let's just say by July 1st, I believe that we'll be testing the 2720 on the S&P. But as far as choppy stuff for this week, I will go. I'm very confident on that part of it, that I don't think that we made a bottom and we're starting back higher again. I think once we get near some resistance levels between the 3080 and the 3100, I think you're going to see a lot of selling step in again.
Yeah. Well, again, I think that viewpoint is probably in line with people who do valuations. If you take the Wilshire 5000 divided by GDP, which we don't even know what it is, it's hard to evaluate stocks. And that's probably why Buffett, hasn't done much, and he's sitting on the cash still, because he doesn't want to go in there and buy things he has no idea what the real value is.
That's something that I've been reiterating to our subscribers is
Yeah.
anybody that's calling a V-shaped recovery. I said it's impossible. I know that Larry Kudlow was just on CNBC saying that we're going to have a V-shaped, if not an I-shaped, because it's just taking off. And my response to people, because I get a lot of emails from that stuff, is how do they? We haven't even started. We have not seen the ripple effect at all from the world economy being shut down for 2 months. And I said, anybody that thinks that they know what's going to happen, I'm like, they're basing it off of nothing, because this has never happened before in the history of our world. So you don't know when you right now you have these businesses that are starting to open. And like I said, in our area here, like restaurants and bars are not even open, or even salons, or some of them are allowed open, but once they open, they're only allowed a certain amount of people that are
Yeah.
going to be allowed in there. So now they're going to have to start paying their rent again, because I know a lot of them had a little bit of a relief for the rent, but they're going to have to start paying that again, and they're going to have to make money on only having a quarter or a third of their amount of customers that come in. So then you have to figure out who is going to be able to survive this environment. And all these businesses that close, then what happens is you have these vacant buildings, and there's a landlord that still has to pay rent on it.
Right.
So that the ripple effect part of it, I said, it hasn't even started. So anybody that's touting a V-shaped recovery, I just don't understand where they're getting their information from, except hoping and praying that that's
Well,
going to be.
I think the thought of the people that are buying is that you're looking at a situation of the employee overhead has been taken off their books, as well as like you say, they're not paying their rent, or they may renegotiate their rent, and they're thinking with lower costs and lower employees that they could make pretty good profits even with less revenue. And I think that's what people are kind of counting on. But everyone's got a point, and obviously your
Yeah,
point
no,
is
and I honestly, I hope I'm wrong.
yeah.
I hope
And again,
nobody wants
the
that.
tri-state area is certainly more affected by this than obviously as you get west of the Rio Grande a little bit.
Right. My biggest concern really is it's going to be the one is the sovereign debt, but on top of that, it's what are the banks going to be able to withhold if I know a lot of people that are on Wall Street. I talk to them all the time, and
Right.
some of them take up 100,000 square feet of,
Right.
of space, and
Right.
they've already said their company, they've done very well with people working out of their houses
Right.
or their home offices. So they're going to be eliminating a lot of that office space. So again, you have these enormous buildings that were just built where they have 500, 600, $700 million mortgages on them.
Yeah.
And if they're at 20-30% capacity, they're going to either have to renegotiate something with the bank, or the bank's going to then take it over. And my concern is how much of that can they actually handle without interrupting their their cash flow.
Yeah. That's true. David, from your viewpoint, are you more of a subscriber to, let's call it the Tom Lee of Fundstrat philosophy that, lower overhead, even with less revenue, will lead to great profitability, and that if you haven't been able to kill these companies with this kind of a shock to the system, it just tells you how strong these companies are? Or do you believe more, along the line of there's a reason why Buffett's not been very active, and that's because it's hard to evaluate in a dark room?
Good question. I enjoyed listening to Gary's take. Actually, Gary, I agree for the most part. I mean, I agree with a lot of what you said. Some of it I would disagree maybe a bit with, respectfully, and I would say, and to get to your question, Jim, I think if you look around and see what's happening around you, and again, I'm in the Seattle area, so we've got the Capitol Hill Autonomous Zone happening in our city. I mean, it's quite an environment here at the moment. But got hit early on with the coronavirus, outbreak was right near our offices here. And so we've been on lockdown since mid-February, and I think it stabilized pretty early, which was good. But we certainly had an inkling that things were going to get pretty bad very quickly. But I think you have to remember, if you look around outside you, if you're in certain parts of the country and evaluate the local economy or even the larger economy versus the markets, you have to remember that they're different, and they're related, but the stock market is designed as a leading indicator of the economy. So when stocks have been going up, even as conditions have been kind of negative, and I think where I'm at, and Gary, certainly where you're at as well, what you have to remember is what long-term investors, what institutions are pricing in. And I think they have priced in, when you talk about a V bottom, I don't think people are expecting that companies will just flick on a switch and be able to operate how they were, but it's a certain expectation of the pace of what they'll be able to do and how much negativity is already priced into it. Where I do agree with you 100% is, I think the fact that the market has recovered to where it has feels a little disconnected to not where things are at right now, but an expectation that things will recover very quickly. And I think I'm with you. I'm seeing a very slow reopening, and we're about at the same with pretty much everything still closed. And I'm seeing the impact with local businesses that are not going to be able to survive this, and restaurants not able to hire people back because of how things have played out. So I think the amount of time it will take for certain businesses to recover, I don't think they will be able to. And I don't think people are necessarily recognizing the length of time that it will take to recover from some of this. And also, I would say the market is not pricing in any sort of secondary return of a corona, a second spike of any sort. I don't think that's priced in at all. So I think if you start to see things materially start to get worse, I think people will get very nervous very quickly. And I think that could provide some further downside. Jim, to your question, just in terms of valuations, I think it is completely uncertain. And I think the challenge right now is, how do you value companies? How do you value this? And when you're thinking about how companies are reporting earnings, this is not a normal quarterly event that you're just sort of looking at what's happened in previous quarters and you sort of make assumptions about where things should be next. I think it's a lot of uncertainty in terms of, for larger firms, and it's not just local companies, it's Amazons and PayPals and Microsofts and larger cloud-based firms, that the impact of this is still very unknown. And for me, when things are unknown, that leans more bearish to me than bullish. Bullish speaks to optimism that things are going to be fine and we have a sense of where things are at. High volatility, higher VIX, higher uncertainty to me feels a little more negative, because we don't know. When we don't know, we don't start buying aggressively. The last point I would make, and sorry for dominating this, but I would say the last thing is no one's mentioned the Fed yet, and I think
that's what I was going to actually ask you.
Also, there's this optimism that central banks will step in and provide. When in an absence of buyers, we have the largest buyer on earth that can step in and buy whatever they want and buy the HYG, buy junk bond ETFs, and support the market. And so I think the biggest, if not one of the biggest reasons why the market continues to trip higher, even when it doesn't seem reasonable to do so, is this expectation that the Fed will step in, and that's the ultimate call option, is the Fed basically providing a floor in the market. But again, I think that is, the market right now is built on an expectation that that's okay. Anytime that there's a feeling that the Fed has run out of bullets, or that the government is unable to keep doing that, or that that will change, I think a lot of anxiety will manifest itself in lower prices pretty quickly.
Hey, David, can I ask a question?
Yeah.
Okay. I'm sorry. Everything you said is fantastic. You're right, and nobody really knows anything. But I just wanted to touch base on the Fed part of it, because do you think, and me personally, I kind of do, is that they're building this illusion, like you just said, that they're going to be able to step in and save the market or buy ETFs. That's a new thing I'm hearing a lot of. But the question is, are they willing to at what point, how much would they put in to try to save the market? And to me, what I think the Fed does is they like I said, give this illusion that they're there, and then from there it brings in real money, say from foreigners or from banks, companies doing stock buybacks and stuff like that. We didn't really see the stock buyback part of this QE, and that's one of the reasons why I thought that we're not taking off to new highs. But the question that I have is what the Fed is doing. Do you think it's a good thing or a bad thing for the market? Because at one, everybody has this belief that the market can never go down, but it goes down, and what happens if they lose control of it? Are they going to lose the trust of everybody? Because everyone's jumping in saying the Fed will never let it down, when it's really not. When you're looking at a free market, I don't believe even the Fed, they're not going to be able to print as much money to maintain control of the market forever. Eventually you're going to, just like with interest rates, they've been trying to keep them down, but the real interest rates are actually going up. So that's where you get this kind of divergence on things, and eventually they have to just let things go. And that's my only question would be, do you think it's a good thing that they're building this illusion of the market will never go down again, because they're behind it, and what that does for investors if they actually lose control? Now everything is going down and people are waiting for them to step in and bid it back up again.
So it's an awesome question, Gary. And I would say, I mean, is it a good thing? I don't know if I could pass judgment on whether it's quote unquote
That's
good
true.
or bad, but it's certainly not sustainable. And I think if you think about what the Fed is trying to do, what their goal is, or what it probably should be, is to give the impression that they're able to do whatever they want, but have them not have to actually do anything.
Yep.
Because then they're not, creating any unintended consequences, any ripple effects, but they're giving this sense that they're there to back, we got your back, stocks are going to be fine, which is essentially what they've tried to do. Now they've stepped in and done a lot of things. I mean, buying ETFs and printing money and all of that. I think the challenge is one of two things happens. Either people lose confidence in their ability to do that, which would I mean, it's based on trust. And if that trust goes away, I think the market could do another February to March very quickly, because it's built on that impression that could happen. The other thing is, if they actually do keep taking action, it can't go on forever. I mean, at some point it starts to create really bad effects elsewhere in the markets. And so in the attempt to buoy up the stock market and buoy up some of the debt markets, they'll create problems for the dollar and elsewhere that are not ideal. And so I think
Yep.
at some point they would have to sort of throw in the towel and say, all right, the bluff has been called. We can't do that much. We just have to let this play out a little bit. But if you look at what happened all through, sort of mid to the end of March, it was all about stimulus, and it was about the Fed being able to step in. And I think when the bottoms actually put in, it was because of that expectation, like, okay, someone's coming in to save the day. JP Morgan's leaving his office and walking over to the exchange and, dropping orders down. And that's what's, buoying the market here. But that it's based on the trust that that's perpetual, and it isn't perpetual. It can't be. And I think that's the dangerous point we're at right now is when that illusion starts to come off a little bit. I think, again, there's anxiety that's underneath a lot of this that'll come out pretty quickly.
I agree 100%. That's a fantastic answer. Thank you.
All right, I'm going to send over to Marina. One thing I did want to just mention, though, as far as the Fed is concerned, their balance sheet was significantly under leveraged basis GDP versus Japan and Europe. So they've got so much more runway. It looks like they've used a lot of runway, but they are still way behind the leverage of Japan and Europe. So I wouldn't underestimate how much they could do, simply because all they're really doing is getting the leverage on their balance sheet higher and a little closer, but nowhere near Japan and Europe. So there's a lot more, in my view, my opinion, based on their balance sheet and percentage leverage versus GDP. There was a lot of room there, and they've used it.
That's what they're hoping you'll think, Jim.
Yeah. Well, I mean, to be honest, that's the numbers, right? I mean, I think it was 20 or 30.
You're right. Totally fair.
Wasn't it 20 or 30% leverage before they leveraged it? And I think Japan's at 250, and I think Europe was at 140. So if you're at 20 and 30, there's a lot of runway there, even though right now it looks like a ridiculous amount as a percentage of GDP relative to the other nations. It's really not that bad.
Jim, the one thing I would just bring, because what you're just saying with like the euro, or the European markets and Japan, is it what they're doing, is it working for their economy and stuff like that? Like their stock market's been okay with it, but as far as what they're overall doing with it, I think is I'm not sure if they're at negative interest rates or where they're at, but like they're actually now cornered into a spot where they really don't have they don't have
Well,
any more
Japan
maneuvers.
is because of their demographics. They have a very
Right.
old population, and you can't grow an economy when you have a very bad demographic. Our demographic, because of the millennials, is absolutely fantastic looking forward. So that's why it's not 100% apples for apples between Japan and us.
Okay, that's good. Yeah,
Yeah.
I'm like I said, with the Fed part with me, I just kind of look at what they're doing and what's happening with, say, speculative traders. So it sounds like you have a much better handle on the different central banks and stuff. So that I was asking you a question on that, so that
Yeah.
I wasn't making a statement.
Yeah, and like I say, they've obscured price, Gary. So I mean, that's the most difficult thing, and that's why Buffett's not coming in here, because he can't figure out what things are valued, because the Fed has obscured prices to a point where even the Oracle of Omaha can't figure out what the heck things are worth.
Yeah, yeah, and it seems like a lot of like the big, those big funds were kind of staying out, saying, "Listen, you got
Sure,
you can push this wherever you
sure,
want, but
yeah,
we're not really pushing our clients to be
no,
jumping in." And
yeah.
you saw it actually Wednesday. Some of them started changing their tune, and then all of a sudden, here comes Thursday, and the Dow's down 1,800 points in
Yeah,
one
yeah.
day. So yeah, it's kind of crazy.
All right, let me switch this thing over to Marina, because Marina has definitely not had her time. So, Marina, I want you to have some time right now, if you would, to give us a little bit more of an idea on some of the methodology you're using on the short-term trading. The feeling I always got with you is you like to keep things on a short leash so that the risk is under control. But again, a little bit more on the methodology on how you come up with the trading situation.
Oh, sure. But my methodology, you could probably use it for everything. I personally stick with the ES minis, but I like to have a very small risk because my profit is only 1-to-1. Basically, it's a 1 point. So in that respect, but it's not about that. I know that scalping has this like negative connotation because you have to make a lot of trades to even come up even, which is a complete story made up. It's misconception, because if your trades have been back tested and have been put into test for a long period of time, if they're over 80 to 85% win ratio, you could easily go in with that 1-to-1 ratio. So my methodology is very different as far as forecasting in the longer term. It's obviously literally watching in minutes almost, because my entire trading session can only last about an hour because it's so full on and so in the moment that my brain can only handle so much high performance activity. And yeah, so it's a little bit different than I think what we're looking at overall in this particular case for the overall forecast as far as my 1 hour trading session, I guess you could say.
Marina, do you use like indicators or anything like that to determine
Yeah,
whether you're going to be going long or short?
definitely. I use only two indicators. I have everything from my one chart. So I use one indicator, which is the MACDs. I absolutely love the MACDs. I think they are probably the least lagging indicator with coupled with EMA lines. I use 3 different exponential moving average lines for my price action. So everything works together. And I have trade setups that have very specific, I guess, like a lineage, right? It's kind of like I say, it's like a recipe. I have to look at specific things that I'm looking for, and if they don't all align, I don't even bother touching my charts.
Good for
So I'm
you.
very conservative in that respect. Yeah.
But you're not doing automated trading. You actually are
No.
making a conscious decision every time you buy or sell?
Absolutely.
I got it.
Absolutely. 100%. Yeah. I mean, I do have my automated setups. Like once I enter a trade, it's automatically 1-to-1, but I could completely move it and I'm sitting there watching it the entire time. I don't have it an automation setup. Definitely not.
Marina, I think the best thing you just said, to be honest, was about if you don't see the right setups, it doesn't look right, you just stay away from it. And I think that if anyone takes anything out of this conversation, I hope it's that, because I think a lot of times people they equate trading with action, right? Like you're
Oh,
trading,
no.
which means you have to be doing something. And the best traders that I've gotten to know, and maybe you should be on that list, are the ones that have the knowledge to just not take action when it's not warranted,
Oh, absolutely. I actually always say there are 3 very important positions in and whatever you're trading, knowing when to get in, knowing when to get out, and probably the most important and completely overlooked is knowing when to stay out. And I'm constantly getting people to tell me, oh, but you're so patient, so disciplined. And if they met me, my husband would be the first to say it's the opposite. But if you get in your car and there's a red light, you just know. It's not a question. Oh my God, should I go? I don't know. There's nobody around. And then you take off and then you get pulled over and then you're all pissed off. And it's like, well, you just ran a red light. So for me, you know, if I don't have my alignment, if I don't have my trade thing set up, it's a red light. I'm going through a red light and then I have to pay the consequence. But it's so true. I mean, don't get me wrong. I was trigger happy. I was going like 30, 40 times. It's so stupid. And you end up losing money on commissions anyway.
Yeah. That's a
Yeah,
tough one.
absolutely. So I'm actually very conservative within an hour, and I'm a scalper. So this is totally like disrupting the whole scalping mentality. I only go for like 1 or 2 to 3 maximum trades. Scalpers usually go in for like 20 a day. So yeah, I'm happy with the way I do it.
It's
It's a
funny that
very
when you
specific-
mention the being patient, that's because as I mentioned earlier, we kind of have like 3 things we go off of. It's the sentiment, the timing model that Woody puts out, and then the technicals. And if it's not lined up, I'm just like, listen, if you're going to look this way, but our recommendation is just sit tight. And it's really bad when you have a service, because people, they want to be in a trade every single day. And I'm like, you're going to lose money if you think that you have to be in the market every single minute. Not day trading. I'm talking about if you're looking to put in, but I said, you're going to lose. I said, the casino always wins. So if you sit there and you think that you always have to be in at every single second, instead of just sitting back and letting the dust settle, I said that like cash is a big position, and it's probably the most important position sometimes.
Oh, absolutely. Absolutely. People don't realize that, unfortunately, the trading industry is probably, or the investing industry is the only one that there's zero barrier to entry. And I actually tell them, I'm like, if you wanted to be a pilot, would you just hop in and take off? Never. But people don't understand that it's the same correlation. How hard have you worked for your money? Do you really want to donate it to the markets? And
Yep.
people just don't get it. They're like, oh, I just press in the pedal and go. I'm like, good luck, man, because you're going straight into negative bank accounts.
Yeah,
But that's their thing,
it's what I find a lot with with a lot of our subscribers, or even people that we try to get on, is they're experts at the tops and at the bottoms, where people, you're crazy looking to short this market, the Fed's in there, and it's almost my own indicator where I'm like, okay, we're about the top right now, because I'm getting these emails. And the same thing with when we're when it's going down and we're looking for a low, it's like you're trying to catch a falling knife, and it's like, okay, a low's coming in here. they just, everybody's experts at the tops and the bottoms, but in the middle, where you really don't want to do anything except either manage a position or add to it. You have to just stay cash and just watch and let the market tell you what it's going to do.
Yes, I always say that because, I think beginner traders, and it's a whole huge misconception that I'm going to beat the market. I'm going to predict what the market does. I'm like, have you predicted the COVID virus? Because let me tell you, that's kind of a daily thing with the market. You'll never know what it's going to do, but you could listen to it and follow with it and work with it. If you're starting to beat the market, you're already beat.
Yep, exactly.
Marina, do people ask you to substitute, say, TLT or GDX or XLF or anything else into your methodology?
I'm not even sure what those words mean. So,
well, in other words, they would be gold indexes, interest rates, banks. In other words, do they ever get say, I'm really looking at these banks, or I'm just looking at this gold stocks, and there's an index, and or ETF. Can we plug in, my interest into your approach?
Right. So using my strategy for what they're interested in. Yeah, they definitely can. It won't be as precise because my trade setups are for the E-mini. However, what I teach is not technically my strategy. Is my goal is to teach you how to fly, right? It's kind of, I always say, like Picasso and Dali, they took the same art classes, but look at what they've created. Every trader is like an artist, right? But you all need to have the basic foundation. And I really always begin with the basic foundation. And then I show how I apply it to my strategies. So yes, you could absolutely, I actually have quite a lot of students that have taken it to futures, are mainly on NASDAQ, and other. What I do really advocate is do one. I cannot even begin to tell you the amount of people that tell me, okay, I want to trade Forex, I want to trade crypto, I want to trade futures, options. I'm like, and then on top of that, a gazillion other instruments inside of those particular categories. And I'm like, if your kid came to you and said, you want to play, can I play a musical instrument? And you'll be like, okay, which one? And they'll be like, he'll say, okay, I want to play the piano, the cello, the drums. And you'll be like, well, you got to pick one.
Yeah.
They're all so
That's a great
different.
analogy.
Yeah. Once you master the one, you probably won't even want to go to the others,
Right.
But I think people think if I trade all of these different markets, I can make more money. But basically what they're doing is just losing more money in different markets.
I agree 100% on that. Stick with one thing.
You want to be Miles? You want to be Miles Davis or Eric Clapton? You can't be both, right?
Yep.
You really can't. And why would you want to be? Why would you? They could play together sometime, but why would you want to be?
Because you're crazy. That's why. Because you're crazy.
Yeah, totally.
Gary, I'm just ask you a question. Sentiment is obviously huge. The quant guys like Kalanovic and Lee, obviously that's a big part of their analysis is sentiment. After you come up with some kind of a sentiment situation, what markets do you tend to use, or do you take that sentiment analysis, and do you apply it to many markets?
It's honestly what we do, we really just use the S&P 500.
Okay.
We're a lot like Marina on that, where it's people can use other instruments, whether they want to use stocks or whatever, but we're really the way that we look at things is either a rising or falling tide is going to take all ships. So if we're looking for the S&P to take a turn, whether it's because we had a series of extreme bullish sentiment readings and we're approaching a time date, we really just concentrate on the S&P 500. But some people like to use the NASDAQ, but they'll look at ours on what we believe is going to happen with the S&P, and if it's especially on the way up. Some of them may just use the NASDAQ because it's going to move a lot faster to the upside, or at least it has been. But we just concentrate on the S&P 500, and Woody's really big with interest rates and stuff like that. He believes a lot of that has to do with moving the markets in either direction. So he does some stuff on interest rates, but our sentiment data is primarily just with the S&P 500, and that's as well as the turn dates that we supply.
The couple of things that go into some of these guys' research is put to call ratios or short interest at the CME, and also active managers exposure to stock. Is that anywhere in yours, or do you have a different sauce?
No, put call ratio is one of the reasons why we were pounding the table last week, as well as stocks above the 50-day moving average. Okay. And typically people will be looking at it as it's a momentum, it's bullish, but when you're sitting there and you have, I believe the stocks above the 50-day moving average was I'm not 100% sure on this, but it was something like a 20-year high. We haven't been at those levels. So when you're looking at that, but you're looking at the S&P that still had 400 points to get to all-time highs, you start asking what's going to be able to bring the S&P up that high. And then we had the put call ratio that was at 15-year highs. So you look at those two things, and then we had 5 extreme bullish sentiment readings. So we knew everybody was just piling on the bullish side as we were running into a top date of June 8th. So those things put together, it was a fairly, easy trade, but I left the door open, saying, listen, momentum could continue. So you want to, build a position. Don't be just going all in, because they may take this thing to close the gap at 3,300. You know,
Yeah,
you don't. But
I thought that might happen as well, Gary. So that's a
yeah,
very good point. A lot of people thought that, yeah, we want to sell it up here, but let's see if they can close that gap first, and they couldn't.
Yep, and that's why I was saying build it. You know, so you have this.
Good idea.
We started at the right around the 3150 up
Mhm.
to the 30, pretty much around the high, because that on that Wednesday, I said, you know, this is where you want to be looking to short this. And I said, leave some, you know, powder dry just in case they head up to the 3,300. But I was like, the one thing that I was really just trying to pound the table on was, this is not the start of a new bull market, not at this particular point,
Right.
just because of what I think everybody's been saying is that just the uncertainty. I don't think that was going to be the beginning of anything. So, but yeah, I did, just to around the world answer, yes, I do look at the book call ratio, and as well as you know, the stocks above the 50-day moving average.
Yeah. One last thing on that, you know, everyone is saying Buffett was an idiot for selling the airlines and this and that. And then I noticed that everyone's talking about how they've had a spike in bookings, but then they note it's still 82% lower year over year. So
I know
that,
it's
you
great.
know,
It's crazy.
yeah,
It's fine. I had just mentioned I just got back from Hilton Head, and I was on American Airlines. And when I went there, I was one of maybe 5 people on the plane. But on the
yeah,
way
there you go.
back, it was 3 rows on each side. Every single seat was taken, and I'm like,
I got you.
what kind of social distancing is this right here? But I
Apparently
think
more
they
people
know
want to
that.
go to the New York area than go to Hilton Head. Maybe that's the story.
I'm not quite sure why. I was like, man, I'm going the wrong way on this one. I want to go back. It was, it's just a different world there
Yeah.
than what
I
is
think
here.
people are
So
just fed up with the whole thing. I live in
Yeah.
Guatemala, and we've been in lockdown, like very strict lockdown, for 3.5 months. And we started it literally after we had one case 3.5 months ago. Now we're literally getting 500 per day, and people just don't care.
Yeah.
They're
yeah,
over it,
They're
you
done.
know, like
Yep.
that's the thing. They're just, and you know, some countries are saying we're reopening. So that means in these people's heads, okay, if the country said so, that means COVID is over, you know, because the virus listens to the government.
right. And the one thing I just say I mean, I have my personal beliefs on when them shutting down the world economy, but it's a lot of it just it has to do with just what's been said from the CDC and the WHO and Fauci, where so many of the things they've said were just they haven't even panned out anywhere near it. You know, wear a mask, don't wear a mask. You can get it from touching. No, you can't get it from touching. Asymptomatic, it passes it. No, they don't. And like people are just like, you know what? I don't
Yeah.
really care what you guys say anymore.
Yeah.
I'm doing this. But you know, the virus is real. It's in the ones that are vulnerable, they have to be careful. But I
No doubt.
think other people just have to start, you know, just getting out, because he can't keep people locked up for 2 months.
No, you can't. And you know what happens? Protests to the extreme, you know, people
Yeah.
being
hmm
locked up, all of a sudden a real horrible thing happened, but the explosion of it, absolutely. But you know what, everybody's so new to this. I kind of feel bad for everybody. I feel bad for the leaders, I feel bad for everybody. Nobody knows what to do, you
Right,
know. It's a
right.
threat on every level. It's a real
I
threat with the virus. It's a real threat. The economy has made people hungry and not, you know, so I don't want to be any part of it. I'm happy being in my house.
Nah.
one of the things that I've said that makes me kind of nervous about just with the whole economy end of it is that we've put the fear of God into a lot of people, that they're not going to change their minds even when things open. They're not going to go back to the regular daily stuff that they've done, and that's where I think the lagging part of the V-shaped recovery that a lot of people are hoping for is there's a lot of people that aren't going to go out to dinner again. They're not going to go to a movie. They're not going to go away. They're going to be doing their essentials they have to do, go to the market, come home, and that's it. And I think there's more people that are like that than some people are really thinking are out there. They think once everything opens, everyone's going to go back to their normal
Yeah.
life. But I think there's a lot of people that just aren't.
Well,
No.
let's. I wanted to ask David a quick question because we're going to have a hard time solving the COVID virus here. Uh, David, a little background. You know, stockcharts.com. You know, what is your methodologies that you're looking at? Is it moving averages? Is there technical indicators? Are you looking at earnings estimates and PE ratio estimates, valuations? What are you looking at?
So it's a mixed bag, and I mean, and obviously with the name stock charts, it's built around stock picking, and so we spend a lot of time looking at the macro picture, looking at major asset classes, breadth, sentiment, and momentum reads, but a lot of it is looking at individual stocks and identifying turning points. And for me, it's mainly a momentum oriented approach. I'm a trend follower, which means my goal is to identify where the trends are headed and lag behind the market a little bit and happily not have to worry about calling a turning point. I just want to be following the larger trend and identifying when it's turned. And I think right now it's an interesting time because the trend has been positive and now we've had this pullback. And the problem is, if you're long-term bullish, that seems totally fine. If you're long-term bearish, you see a top. If you're bullish, you see a pullback. If you're bearish, you see a top. And I think you have to see what happens next from here. Is this a buyable bounce that returns and stocks bounce a little bit higher, or do we break down through support and stocks like Twitter and others sort of move lower? So for me, it's a lot of looking at individual stock charts, and it's pretty straightforward, looking at support and resistance levels, looking at moving averages, and RSI is the one indicator I would use besides price. And the second one would be PPO, which is an adaptation of Marina's MACD. It's just based on percents instead of price, but the indicator kind of plays out in a very similar fashion. And so those are the ways that I try to understand that intermediate term trend, sort of looking at the next couple weeks to the next couple months, ideally.
Do you center on certain sectors like, tech and semis and healthcare that have been doing great, or do you try to go across the board?
Yeah, no, it's a big focus on sector and group rotation. And so one of our tools is called the Scooter rankings. It's the stock charts technical ratings. So we have a very simplistic quantitative trend following device, which basically percentile ranks different universes by their trend characteristics. So it goes from the 99th percentile strongest uptrends to the first percentile strongest downtrends. And so we look a lot at how sectors are represented across those different tiers and what stocks are bubbling toward the top of the list and what are bubbling more toward the bottom. And based on what you said, I think financials have been challenged for sure. And I think the uprise you had in energy and financials, those beaten down sectors, like the beaten down financials, the industrials, things like airlines and others, energy stocks that rallied so quickly, kind of came back to earth in the last week or two. And so I think the question now is, do you return to the leadership of technology, which has been sort of slow and steady outperforming for years, right? Not just recently, but over a period of years, and outperformed during February, March downtrend, but also outperformed on the way back up out of the March lows? Or do we sort of continue this rotation more toward the value-y parts of the market? And my guess would be the market struggles, and I think those value-y areas like financials and others that have rallied so quickly, I think they come off a little bit. And I wouldn't be surprised to see the XLK continue to outperform, even though the price might come off a little bit. It'll continue to do better than other sectors because I think a lot of people will continue to treat those mega cap tech and communication services stocks as a safe haven. And the chart of Microsoft probably best illustrates that pattern.
Do you think the home builders like ITB and then, Lennar and Pulte, et cetera, have a good future ahead of them because of the demographic, among other things, the demographic of the millennials being between 20 and 37 and possibly establishing, homes and stuff like that?
So I'll give you the short answer is yes. I think the home builders are setting up very nicely. The reason why they're setting up nicely is what I'm not so sure about. As much as I think, when we think about millennials and where they're at in their life cycle, and they're at the point where they should be investing more and more in equities, they should have investable assets, they should be buying houses. I think the trend we've seen is not that. It's almost the opposite of that, right? There's sort of this anxiety about equities because it's not been a great asset class since, for at periods of time for sure. And in general, the trend has not been millennials buying houses aggressively. It's renting and living with your parents and doing all these things. If and when that materializes, though, I'm more concerned with the charts, and I think the charts are all pretty compelling. Lennar, DHI, all of those groups. You see that they're retesting previous highs. They've pulled back, but overall setting up really, really well. So I think I wouldn't be surprised if they continue to do well in the second half of the year.
Yeah,
David,
it's
can I ask you
early.
a question on the home builder part of it with the millennials? Do you think it's a lot of it has to do with just the price tag that they have on their forehead when they leave when they graduate college, having to, they have $130,000 tuition that they have to pay for the next 20 years that they can never, no matter if they file bankruptcy or whatever, they're still obligated to that. Do you think that has anything to do with the millennials not really going into investing and buying real estate?
It certainly could be, and I think what you have to think about is if you treat the demographics as in, all right, here's a new generation, it's a huge cohort, like the millennials, it's a big group, and could they materially move things? Would they move stocks higher? Would they buy houses and it would and housing prices would go up? Like, all of that is true, but we're assuming that they will behave as a cohort similar to previous demographic groups, previous groups. I don't think that's the case. I think part of it is, for me, you think about I've often thought about where you start investing and how that sort of skews your thinking for the future. So, for me, I started in the financial industry in mid 2000. So I learned the technical toolkit when the market was getting crushed and the tech bubble was exploding or rupturing, and people were telling me how easy equity investing was, and then it wasn't, and there was 9/11 in New York where I was at the time, and it was just this whole mess of negativity. And so I learned technical analysis really more as a risk manager, thinking about downside and how to manage that. But one of my analysts at Fidelity started in the industry in 1982, and so he learned technical analysis during a raging bull market when everything just seemed to keep going higher. So I think when you think about where millennials have been and what's happened to housing prices since they've been at the age when you start paying attention to it, they've learned that housing prices are not a great savings account. It's not a great bet to own a house. It's better to rent. And so I think there's less incentive for them to want to do so. And also with equities, I mean, during this period, I think the challenge is there's been this stretch from 2009 to now where anyone that's started investing in the last 10 years up until 6 months ago has known nothing but a raging cyclical bull market within arguably a raging secular bull market. And I think they're very unprepared for a downturn in stock prices. And so I think that's going to be, it's those things that are going to impact it more than student debt. But that seems to be one other factor that also could contribute to it for sure.
Yeah.
All right,
absolutely.
you guys, we're at the excuse me, we're at the top of the hour now, so this is a good time for everybody to tell everybody how to get a hold of them and what special offers you have, if any. This would be the great time to offer them as well. So we're going to start out with Marina from the Trade Chick, and Marina, tell them what's going on.
Okay, well, thanks so much, everybody. Oh, hang on a second. Oh, okay, yeah, David just sent that. So you can find everything you need about me is through thetraderchick.com, obviously, but David just added in how you guys could also get a free cheat sheet. So basically with the cheat sheet, it's literally showing you my process, the strategy, and it can definitely be applied to any market, what you'll learn with the cheat sheet, and it's simple and fun, and you could always contact me through thetraderchick.com. And thank you so much, everybody. This was actually probably the most interactive, most fun conversation. I've done this before, but it's been a while. So thank you for having me on the show once again as well.
Thanks
Thank
a lot,
you.
Marina. That was great. Gary, a little background again, and what we can get from the sentiment timing, and any special offers you might have for the group.
Well, anybody that would like to reach out, you can contact me at Gary@sentimenttiming.com, and it really the offers that we're doing, we have a lot of important turn dates that are going to be approaching, but really the most important part is just following what the investor sentiment, because that's really been helping everybody out that follows us. And you can do, if you send me an email, we have different coupon codes that are going out, but our latest one, you can test out our service for $1.99 for 2 weeks and see how really amazing that the service is with timing the markets and using sentiment to kind of confirm when that turn date is coming, as well as putting it into a technical analysis as far as where you want to be looking to go short or long.
Okay, fabulous. David Keller, a little background. And again, how can we reach you over at stockcharts.com? And if you had any special offers, is a good time as well.
Yeah, thanks so much, Jim. This was fun. I appreciate you moderating very capably. I appreciate it. And Marina and Gary, I was less familiar with your work, and I really, really appreciated hearing your perspectives. So it was a pleasure to chat with you guys today. Yeah, go over to stockcharts.com. There's a free version of the site, which you're welcome to use, and we focus on tools, which are technical and behavioral tools, but also commentary and education to help you make better decisions about your investment portfolios. And you can we have a paid version of the site. You can get a free month if you head over to stockcharts.com. But thanks again, guys. This was a lot of fun.
Sure. Again, everybody, I do have a weekly market update. It's free of charge. You simply just put your email in and we send it to you each and every week, going over stocks, bonds, crude oil, interest rates, gold, etc. So that's optionprofessor@gmail.com. Again, great time here, guys. You added a lot. I think people learned a lot. And of course, they should definitely follow up and get more information and find out how you guys might be able to help them. Right now, I'm going to turn it back over to David. And again, thanks, guys, for being here today.
Thank you.
All right. Thanks, everyone. Great discussion. So just a quick reminder before we end the show, be sure to subscribe to Timing Research on YouTube or your favorite podcast directory. You can also go to TimingResearch.com to get access to the recording of this show as soon as I can get it posted, or any of the past reports or shows there. And just want to thank my guests again for today. One more time. Marina Villatoro.
Thank you very much.
Yeah, thanks, Marina. Marina Villatoro of thetraderchick.com, Gary Dean of sentimenttiming.com, David Keller of stockcharts.com, and Jim, the Option Professor at optionprofessor.com. Thanks, everyone.
Thank you, Dave.
Thank you, everybody.
All right. Bye-bye, everyone.
Bye.